Ask any Australian which city has performed best for property over the last 20 years. They'll say Sydney. Maybe Melbourne. Maybe Brisbane. They'll be wrong. The actual answer is Adelaide. Today we break down the data, and explain why most investors are still ignoring Australia's quiet champion. Let's start with the headline number that shocks every investor who sees it. According to the CoreLogic Hedonic Total Return Index, which measures capital growth combined with rental income over time, Adelaide has delivered total returns of over 560% across the last 20 years. That beats Sydney. It beats Melbourne. It beats Brisbane. It beats every Australian capital city on a total return basis. And almost nobody knows this. In a recent survey of Australian property investors, only about 5% picked Adelaide as the top-performing market. 95% of the market is wrong about something that's clearly documented in the data. That information gap is the opportunity. Adelaide has been quietly compounding for 2 decades, while every property investor has been distracted by Sydney Harbour views and Brisbane Olympic hype. The data tells the real story. So how did Adelaide do it? 3 structural reasons. First, sustainable affordability. Adelaide never had the explosive booms that Sydney and Melbourne experienced, which means it also avoided the painful corrections. The growth has been steady, year after year, decade after decade. Second, strong rental yields. Adelaide consistently produced yields 1 to 1.5 percentage points higher than Sydney for most of the last 20 years. That income compounds powerfully over time. Third, supply discipline. Adelaide has had less land speculation and less apartment overbuilding than the eastern capitals, which has supported pricing through the cycles. The combination of steady capital growth plus stronger income plus disciplined supply produces compounding that beats the dramatic booms and busts of larger markets. Adelaide is the tortoise in the property investment race, and the tortoise has won. Adelaide's outperformance isn't just historical. The city is in the middle of one of its strongest growth phases ever. Median house prices have crossed $800,000 in 2026, up significantly from 2023. The reasons? Defense industry expansion driven by the AUKUS submarine program, which is bringing thousands of high-paid jobs to South Australia. Interstate migration from people priced out of Sydney and Melbourne. A genuinely tight rental market with vacancy rates well below 1% in some suburbs. Strong overseas migration to South Australia. And a state government that has been more pro-development than its eastern counterparts. The combination of these forces has created sustained pressure on Adelaide property prices. The current cycle has years left in it, even after the strong growth already recorded. Investors who got in 5 years ago are sitting on substantial gains. Investors getting in now are arriving later, but the trend is intact. Let's get specific about where the growth is concentrated. At the affordable end, suburbs like Salisbury, Elizabeth, and Davarin Park have posted exceptional percentage gains as first home buyers and investors chase entry-level opportunities. Properties that sold for $300,000 a few years ago now trade in the 500s. In the middle ring, suburbs like Norwood, Unley, and Prospect have performed strongly, supported by character housing stock and proximity to the CBD. At the premium end, North Adelaide, Walkerville, and Burnside have hit record medians, with several 7-figure sales becoming routine. The Adelaide market is broadening across price points, which is a positive sign for sustainability. Investors looking for the best opportunities right now should focus on the middle ring, affordable enough to access without million-dollar deposits, but established enough to weather any future downturn. One detail that property investors miss about Adelaide. Units have actually outperformed houses on a total return basis over the last 20 years. This is unusual. In Sydney and Melbourne, houses dominate. In Adelaide, well-located units have produced exceptional combined growth and yield outcomes. The reason is straightforward. Adelaide unit supply has been more disciplined than in eastern capitals, and Adelaide unit buyers tend to be owner-occupiers rather than investors, which produces more stable demand. For investors with limited capital, well-chosen Adelaide units in established suburbs may offer the best risk-adjusted returns available anywhere in Australian property right now. Adelaide is not risk-free. 3 concerns worth flagging. First, the strong recent growth has compressed yield significantly. The yield advantage Adelaide enjoyed over Sydney and Melbourne has narrowed sharply. Investors buying now will not benefit from the same income compounding that drove returns over the last 2 decades. Second, the UK-US driven employment boom is concentrated in specific industries and geographies. If that program is delayed, scaled back, or shifted to other states, the demand support evaporates. Third, Adelaide remains a smaller market than Sydney, Melbourne, or Brisbane. Liquidity in any downturn would be tighter. None of these risks invalidate the Adelaide thesis. But investors who treat Adelaide as a guaranteed winner are setting themselves up for disappointment. It's a strong market, not an invincible one. 3 rules for any investor entering Adelaide in 2026. First, focus on established suburbs within 15 kilometres of the CBD. The fringe estates may look cheaper, but they carry oversupply risk. Second, prioritise rental yield over speculative growth. The big growth gains of the last 5 years may not repeat. Yield is what compounds when growth slows. Third, plan for a minimum 10-year hold. Adelaide rewards patience. Investors trying to flip Adelaide property in 2 or 3 years will find liquidity disappointing. Hold for a decade and the math works. Let's dig deeper into one specific driver that has the potential to reshape Adelaide property for the next 2 decades. The UK-US submarine program. Adelaide has been selected as the primary construction site for Australia's nuclear-powered submarine fleet. This is not a small project. We're talking about construction activity that will run for 30 years, employing thousands of high-skilled workers at premium wages, with associated supply chain businesses, contractors, and research institutions. The economic multiplier effects on the South Australian economy will be substantial. Already, demand for housing in Adelaide's northern suburbs near the Osborne shipyard has spiked. Suburbs like Largs Bay, Semaphore, and surrounding areas have seen above-trend growth that directly correlates with a UK-US related employment. This is one of the most predictable structural drivers in the Australian property market right now. A less obvious Adelaide angle worth understanding. The Adelaide Hills and Barossa Valley regions are arguably underpriced relative to comparable wine country regions in Australia. Compare the Adelaide Hills to the Hunter Valley or Yarra Valley. Quality of land, infrastructure, and amenities are similar. But Adelaide Hills property remains substantially cheaper. Why? Simply because Adelaide has been culturally underrated. As more Australians and overseas buyers discover the lifestyle quality of the Adelaide Hills, that valuation gap will likely close. Suburbs and towns like Stirling, Bridgewater, and Hahndorf offer character properties at prices that would be impossible near Melbourne or Sydney. For lifestyle-focused property buyers, this is one of the most interesting opportunities in Australian real estate. The wine country thesis is similar to the broader Adelaide thesis, underdiscovered value with quietly improving fundamentals. Project the Adelaide trajectory forward 20 years and the numbers get interesting. If Adelaide continues to produce the same total returns it has over the past 2 decades, a property purchased today for $800,000 could be worth significantly more than $2 million in real terms by 2046. That's based purely on extending the existing trend. Now, past performance does not guarantee future results. Adelaide may not maintain its historical pace. But even if returns moderate by 30% from the historical average, the outcome would still be exceptional. Compounding works most powerfully in markets that produce steady, reliable returns over very long periods. Adelaide has been precisely that market. The historical evidence supports continuing this pattern as the base case. So that's the Adelaide story. Australia's quiet champion. Outperforming the big capitals for 20 years while nobody paid attention. Still strong today, but with risks emerging that investors must respect. If you found this useful, smash subscribe. We break down Australian property markets every few days. And if you want to know which Australian cities are heading in the opposite direction, with prices actually falling in 2026, click the video on screen. We'll see you in the next one.